Hello, everyone. Today we're going to talk about buying calls, not covered calls. I tend to prefer covered calls, but I did get a request this week about call options, so learning about call options and also put options. So we're going to go ahead and tackle that subject. Now, that being said, I actually let's take a look at our agenda. So for buying call options, number one, I don't recommend buying call options, especially as a short-term investment. It's very, very risky. It's um, unlikely to be profitable, generally speaking, in terms of the statistics. And it's a really high risk endeavor. I understand why people do it because there's the potential for large profits in a short amount of time. But I actually do the opposite. I take advantage of the people who buy options, right? And I go ahead and sell them options. I sell them covered calls. That's not to say everyone who buys options does it in a way that's risky. Sometimes you can do it in more advanced strategies such as hedging. We'll talk about this all within the video. So sit back, enjoy. If you want to grab some popcorn and drink, you're welcome to do so. So let's go ahead and continue. So why don't I recommend it? And this is going to make more sense as we go, but I just want to lay out why I think they're a bad idea. Number one, they're high risk due to expiration. So the big kind of sell of buying a share is that you own it in perpetuity. Now, that's a fancy way of saying you own that share. So if I buy a share of Coca-Cola, I own that share until either A, I sell it, right? Or letter B, the company goes bankrupt. Not saying that the company will go bankrupt, but if it does, then that's another way I could lose ownership of my share. So there's really only two ways if I buy a share. Either I sell it, right? Or it goes bankrupt. Technically, there is a third way, and that's if it gets bought out, but then I would be rewarded with generally a higher price. But let's just consider those two. So essentially, why is buying shares so safe relative to that? It's because you own it forever. If you think Coca-Cola is going to go up, well, you're likely not going to lose money in the sense that if you have all your, due diligence done, if you know for a fact that this is a solid company, then all you have to do is wait. It doesn't matter if the stock market's depressed for a few years, months, years, weeks. It doesn't really matter. You can wait as long as you need to, and you recover your initial cost, and you get some profit. Right. So if it's a solid company and over time it goes up, you have all the time in the world to wait. That's not true for calls. For options, so calls and puts, they have an expiration date, and so you don't have the luxury of being able to wait. You have to have it go up in price by a certain date or within a certain time frame, and if it doesn't, you've just lost your investment. So that's the big difference between the two, and that's what I'm going to stress as the difference between call options and being a shareholder just outright owning the security. So for the next part is, a lot of people especially tend to buy out of the money. Buying out of the money means buying above the price, buying with the strike price that's above where it currently sits. So let's say, for example, as an example, let's say Google was $100. Let's say I'm betting that it's going to go above $150. Well, how likely is it that it's going to go up, up to 100, from 100 to 150, and then past 150? It becomes a lot less likely, right? So if you buy out of the money, which means you're saying that you want it to go up a certain price, and then in order for you to profit, you have to go past that price. So in order for you to profit in that scenario, Google's at 100, Google would have to hit first 150, and then you start potentially making profit, maybe. And it just depends on how much you paid for that contract as well. Now, the reason why people do that is because they tend to be a lot cheaper, but they have no intrinsic value. And we'll talk about what that means in a little bit. The next thing I do want to add is there are ways to be safer with your buying calls. Typically, this is something called LEAPs. These are long-term equity anticipation securities. Don't worry about the name. Just know it's called LEAPs. It's really just a call option with a long expiration date. So you can imagine instead of it being a week expiration, which is terrible, or a month expiration, pretty low too, because you can go weeks, like 2 weeks, 3 weeks, a month. You can go several months. You can go a year and a half, or up to 2 years, generally speaking. So a leap would be something around like the 2 year period. This is where you can have a call option expire in, let's say, 1 year, 2 years, year and a half, or so forth. The reason why this is more favorable because it starts to mirror more of a stock where you can have it for a long period of time and you can wait. You can sit on it and wait until it makes the move, until it goes up. and you can be profitable, right? Assuming that the company is going to go up because it's a solid company, then you're in a much better position. Because sometimes out of nowhere the market corrects, the S&P 500, right? The overall market will correct, so it'll go down maybe like 20-30%, and it has nothing to do with your stock. You know, say your stock is solid, everything's going right with it, but the whole market went down. So as a result, your stock went down. And suddenly, even though you made the right call in terms of the company doing everything right, well, if you have a short time frame, well, there you go. You just lost your money, unfortunately. But if you have a leap, you can wait it out, and you can wait until it recovers, the market recovers and does its thing. So let's go ahead and talk about our next point, calls versus puts. So calls are essentially, they're both contracts. They're both contracts. The only difference is we're going to be discussing today calls. In the next video, we're going to discuss puts, but for calls, it just means that you're betting the strike price to go up. It's effectively very similar to being a shareholder, right? You buy some Coca-Cola. Why? Because you think it's going to go up, so you can sell it at a profit. Buy low, sell high. That's really all the call is. You're waiting for it to go up. Puts is the opposite. Puts is you're buying high to sell low. So essentially you're wanting it to go down. So if you ever want it to go down, there is a way to do that. There's shorting, just depending on if the brokerage has that available, or a way to kind of mimic shorting is buying a put option. A put option is analogous to like buying a call option and buying shares, right? So if you buy a call option, that's the contract version, versus if you buy shares of Coca-Cola, that's the share version. So that being said, now that we understand call options means you want it to go up, let's go to our next part. So as a summary, what is a call option? Because there's a more formalized definition which talks about like obligations to be able to exercise contracts and so forth. But let's talk about it simply, what it really is. It's a leveraged long play. What does long mean? When you're long something, that means you want it to go up. And leverage generally means that you're being able to increase your position. Generally has more risk tied to it, but you're able to increase your position. Now, in this case, what context are we referring it as? So you can actually spend less money, less of your money, like a fraction of your money, and instead of buying just the stock, and you can have the same potential return if it were to jump. So for example, the people who are on GameStop, as an example. So the reason why people bought calls is because generally speaking, let's say if the stock was $10, hypothetically, let's do example time. So let's say that the stock was $10 for GameStop. Now, if I wanted to buy 100 shares of these, so how much would 100 shares be? Well, $10 times 100, that's going to be $1,000 that I would have to invest, right? I would have to have $1,000 to get 100 shares of GameStop. And let's say it went up to, I don't know, let's say it went up to $12. $12. So each of my 100 shares gained $2. So effectively, my profit would be $200. Pretty nice. Now, what if, on the other hand, well, the thing is, I had to invest $1,000 to gain $200. I gained 20% profit effectively. What if, however, instead of doing something like this, I only had to invest, and this is initially what happened with GameStop because the call prices were very low. I only had to invest maybe like $20. $20 for a call contract. Okay. And then what happens is I'm betting that it's going to go above $10. And then it goes up to 100, or it goes up to $12. And I bought just one of these contracts for $20. So what ends up happening? Well, it's almost as if I owned 100 shares. We'll talk about this in a little more detail. I just want to explain why it's so attractive. It's because, let's say I only paid $20, but it's almost as if I had 100 shares. And so when it went from $10 to $12, I actually still gained $200, but I didn't profit $200. You have to subtract the original 20 that I invested. And so I actually gained $180. So it's 9 times the profit. So in that same move, in that exact same idea, I would have gained 9 times my money. So you can imagine if I bought as many contracts as possible and look with my entire stake, then I'd 9x my whole portfolio, which is really nice in terms of an idea, but this generally doesn't happen. It can happen, such as with GameStop, and that's how people went from having a few $1,000s to being multi-millionaires. And that's the idea, and that's what people generally hope for. So let's continue. So buying a call option. A call option, as we kind of saw in our example, represents 100 shares. It's almost as if you were the owner of 100 shares, but temporarily, and then you only gain value after a certain price. Let me just reflect that. And this is what's going to be known as the strike price. So we'll talk about that. So it's temporary. Those 100 shares are temporary, and you only gain value after a certain price. Okay, so that's something I want to share. So what are the factors that come into buying a call option? There's really two factors. The first one is the strike price. The strike price determines the point in which you start gaining money. This point at which you start gaining what's called intrinsic value. So essentially, it's the point at which for every dollar the stock moves, you gain $100 in value. Now, I don't want to say $100 in profit, because as we saw in this case, when we move $2 past our $10, our strike price, then we actually gained $200, but not $200 of it was profit. The initial investment, we had to recoup that, and so that's actually it's not pure profit, right? So some of it's recoupment, and then afterwards the rest of it's profit. So that's why I'm careful with my wording, and I say the strike price, it's the point at which for every dollar after the strike price, so let's assume the strike price was $70. For every dollar after 70, you're gaining $100 worth of value. So it's very nice. It's very, very nice. It's almost like that's why I said it's the same as owning 100 shares effectively. Now, for the strike price, you can either choose to buy out of the money or in the money. So let's take a look at an example of that. So let's say if I want to go to SoFi, as an example, I go to trade options, and this time I'm not selling, I'm buying calls, hypothetically. So we could see here, right here, I can choose to buy a call option for $17. So remember, this is all in terms of 100. So that's why even though it says 17 cents, it's times 100, so it becomes $17. Even though this says 52 cents, this is times 100, so it becomes $52. So right now the price is $6.50, right? Exactly $6.50, which is nice because it lets me show three options. So out of the money is like, what's something above $6.50? Well, $7, right? $7 is above $6.50. So this is out of the money, which means that I have to, in order for me to make money on this, the stock would have to jump from $6.50 to $7, and I wouldn't be profitable at $7. I wouldn't even break even at $7. That's when I start to gain value above $7. So after $7, then I'm making money. So this is what's called out of the money. Now, why would people want to buy out of the money? They're cheaper. Look at this, $5 for the week. That's cheap. So that's why people would buy out of the money, but it's a lot less likely to happen. The next one is at the money. At the money is not always there, but at the money means it's essentially the same price as what the stock price is. So you can notice the stock price is $6.50, and at the money, this contract is essentially betting that it's going to go above $6.50. Well, it's more likely to happen, right? Because if it's going to go up, then I'm already making money if it goes past 650, or I'm starting to gain value if it goes past 650. So let's say if this were to go to 750, I would gain $100, but I have to initially invest $17. So effectively, I would do 100 minus 17, so I would gain $83 of profit, which is several times this value. So that's good. So this is at the money. In the money is when the contract is, so it's when the price is below the price of the contract, the strike price is below the share price. So in this case, notice I'm saying I'm betting for it to go above 6, but it's already above, how should I say? It's already above 6, right? It's 6.50. So how does this work? This tends to confuse some people. And what happens here is, notice, I start making $100 every point past $6. And you can do this in terms of cents. So for 1 cent, it's $1. For 2 cents, it's $2, and so forth. So just keep that ratio in mind. So since it's 50 cents above right here, then what that means is, since it's 50 cents above, what that means is, sorry about that, I had to get that in me. If it's 50 cents above, that means I have $50 worth of value here. So if I were to buy this contract, right? If I were to buy this contract and then sell it, I could sell it for $50. But look how much the contract cost me, $52. So if you buy in the money, you'll notice it looks more expensive in the sense that it costs me more money. But in reality, this contract effectively, if I were to buy it, it has already $50 worth of value. All of these out of the money have $0 worth of value. This has actual value in it. This has what's called intrinsic value. That means if I were to buy this contract right now, and this, let's say the market was open, if I were to buy it right now and then sell it right away, then what would happen is I would get $50 back. So I would lose $2, but that's okay. Now, if I bought any of these contracts and then sold them right away, I wouldn't actually exercise them, but you effectively, you would get no money. So there's no money in these contracts. These are what's called pure extrinsic value, which means the only reason you're paying for them is because of the time. You have until this week, until this days to make the move happen, which is you want the price to go up. In these cases, they have built-in value. They have intrinsic value. So like I could buy this contract and then sell it right away and recoup a lot of my money, right? Or some of my money, some portion of my money. So these have what's called intrinsic value. So going back to this one, let's say 550 right here. You'll notice this is $1 below the strike price, right? So this actually, it has $100 worth of value here from 550 to 650. So this has $100 worth of value, but you'll notice it cost me 114, which means if I bought this for 114, I could sell it right now for $100. So I would lose $14, but you could see that I'm deeper in the money. And the reason why you would want to go deeper and deeper in the money is because you're safer. And now, obviously, it costs more, so you also have to do a cost-benefit analysis of like, at what point is it better just to buy the stock price, right? Because if you get low enough, the stock price is 650, who's going to buy this for $540? You might as well just own the shares at that point, right? But you could see how you can leverage yourself because these are a lot cheaper than the just buying 100 shares, which would cost you $650. So instead of investing $650, you can invest a smaller amount of money for large gains. Right? Now that said, let's go back. So expiration date is another factor. Expiration is the latest time in which you can sell the contract for money or it expires. So up to expiration date, you can always sell back your contract. So it's very fluid. But at expiration, there's either three outcomes. Either let's just assume so right now it's 650, and let's make some assumptions. Okay, so let's say I bought the $7 strike price. Let's just say I wanted to be risky and I just bought this. So what happens? What are the options? And what are the possibilities? No pun intended. So let's say I bought this $7 one, and then what was the first option I wanted to do? So let's do out of the money. What that means is I bet that it's going to go above 7, but it doesn't. So it doesn't. So what happens of that? Well, I paid $5 for this contract. After the week is done, June 21st, I lose that $5. So everything I invested, which is $5, right? It's not that much, but still, you would lose that money. So that's if you're out of the money, which means you did not make it to the price you were betting at. So it doesn't matter what it is, like $9. If you didn't make it to $9, then you lose that money. If you didn't make it to 650, you lose that money, right? And what are ways you cannot make it? It's either if it stays the same or it goes down, generally speaking, if people buy out of the money. Now, if people buy in the money calls, generally these are safer in the sense that they already have built-in value. But let's say the stock price goes below $4, it just keeps dropping, then you're out of the money as well, which means like, let's say the share price goes to $3. Well, you didn't make it above 4, so you're out of the money, you lose your investment. You would lose all $250 actually. That would be pretty unfortunate. So next one is at the money. So let's say you bought an option and then the share price on June 21st at closing day of the market ends up being exactly the price that you bet it would be, but you wanted it to be above. You don't want it to be at that price, you want it to be above. So if you're at that price, at the money, you still lose your money. You didn't get to recoup anything. At the money means you're just at the point where you would start gaining value, but you didn't, right? You kind of made it just to that point. Now, in the money is, let's say, for example, I bought this 650 call for $17, and then it went up from 650 to 750, or let's call it $8. Let's say it went from 650 to $8. Well, because it's $1.50 more than this, that means I gained $150 in profit. Remember, each dollar is $100, so $1.50 is $150. So I didn't gain $150 in profit. Excuse me for that saying that. I gained $150, but my initial investment was 17, so it would have been 150 minus 17, $133 of profit. Which, so let's say if I did buy this contract and it did go to $8, well, we can do the math on that. So how much is profit again? 133 divided by my initial investment of 17. Oh, I would get 7.8 times my money, or 780% return, which is really, really good. But how likely is that to happen, especially with SoFi right now? Not likely. And I'm actually a share owner of SoFi, so I can kind of just clown around with it a little bit. So that said, so what are the expiration outcomes? Once again, out of the money means you didn't make it. So you lost all your whatever you paid for the contract. In the money means, or sorry, at the money means you made it exactly at that price, but you didn't get any more value from it. So you also lost your money. So this one is you lose investment. Here you lose the investment. And if you're in the money, it just depends, because you have to first recoup. So you first either have to recoup the value. Remember, so like I said, if I was at 650 and let's go back to this example. So if I bought the 650 and it's at 650, in order for me to break even, it would have to go up 17 cents. I would have to reach $6.67 in order for me to break even. And you can see that here. If I go to it, you'll see its break-even price. It should have the break-even price. If not, that's okay. Well, you can calculate the break-even price by just putting whatever the strike price is plus the premium. That's your break-even price. So in this case, the break-even price of this contract is 705. So if it goes to 705, you broke even. In this contract, if you go to 752, you broke even, and so forth. Now in this contract, you could see that it's $6 plus 52. You break even at 652. So you don't have to move that much in this case to break even. So this is nice, right? You can see how buying in the money contract is pretty nice in the sense. So first you have to recoup the value, and then afterwards you profit. So if you didn't get to break even, then that means you still lost money because you didn't get to recoup your investment. Now, if you get past your break even point, then you're profitable. And so those are the three outcomes. It's very important that you understand this. Please definitely rewatch this section of it. If I could share a few kind of points. And once again, this is not financial advice. It's just more so just the idea of knowing how these contracts work. This is a very important part of understanding if you're profitable or not. I remember I bought my first call option and had no idea really how it was working. It was just a coworker of mine told me, it's like, this would be a good idea. And it expired out of the money. And I was like, where's my $8? And it's just gone. But that said, let's go move on to our next point. Contracts are liquid. So generally speaking, contracts are liquid. Options are liquid. It just depends if so this is where you have to be careful, because I say they're liquid in the sense that if you buy it, you don't have to wait until the expiration date, right? So expiration dates here. So you can buy it for June 21st. Now, oh, sorry, I don't think I mentioned expiration dates. I apologize. So the shorter the expiration date, the less money it costs you, but the more risky it is. So this is actually a very, very important point. I don't know how I missed that. So let's say you go to, January, which is way longer than 1 week. You can see, yeah, it's more expensive, right? So the $7 contract is way more expensive than what was, I think, like a $5 contract. But you have way more time for this to move above $7. And what's more likely, that it's going to move above $7 in 1 week, or that it's going to move to $7 in 6 months? Now, if it's a solid pick, if it's a solid stock pick, you know the company's doing well, then it's more likely to happen, right? Like, we're assuming that you're picking a solid company. I don't know why you would buy a call option on something you didn't believe was going to go up, but anyways, if it were to go up, right, you have more time for it to happen. And that's one of the advantages of buying longer term out. That said, the downside is it costs more premium. It costs you more money to buy this option. So it actually has to go higher in order for you to recoup your investment if you're waiting until expiration. But you don't have to wait until expiration. If I buy it for $2.15 today, and then it goes up $1, I actually gain money there. And there's something called delta. We're not going to really talk about it too much, but effectively, if it goes up $1, this 0.66 delta tells you how much on average you would gain. So if this goes up $1 from right now from 650 to 750, I would gain about $66 of my position. So let's say I bought it today for 215, I could sell it for about 60, let's call it $65 increase. So that would be what, $280. So I would gain a profit. So the goal of this is that you want it to go up as soon as possible because you can sell it as soon as it goes up. You don't have to wait until the expiration date. You're not locked in. You can always sell it back, the contract, for a profit if it goes up. Now, if it goes down, your contract becomes less valuable, and then you could sell it back to, I mean, to kind of save whatever you have left of it, right? So let's say it goes from 215, or let's say the stock price goes from 650 down $1. So then you would roughly lose about $66 worth of your value. So minus that, that would be what? 150. So you would only have $150 left on this. And then so you could sell it back and, you know, try to not lose all your money. That's another way to do it, right? So you don't have to wait until expiration. That's also another very important point. You don't have to wait. It's very fluid. You can sell it before, but this is where it means this is where we have to understand the idea of intrinsic value versus extrinsic value. Extrinsic value, why would it still cost money if it drops to 550? Why would this still be priced worth money, right? Because it's out of the money. People have to go all the way to $7 and then above just to make money. Well, the reason is because of the theta. Theta is the idea that, time expiration. The idea that you can leverage yourself and you still have days left on the contract. That's worth value. The fact that you have days left on the contract, months left worth on the contract, years, that's valuable. Even though it's out of the money, right? So it's, you still have to go up some money and then afterwards even more to get profitable. That's worth some value. That's what's called extrinsic value. So this is the idea of there's days left on the contract. Days, month, weeks, months left on the contract. Right, that's it. Now, intrinsic value, as we discussed before, it's the actual value within the contract. So what that means is, this is like, let's say if you sold, let's say if you, so you first, you have to be in the money. And then let's assume if you sold it immediately, how much would you make? That's the intrinsic value. So if you sold it immediately. For extrinsic value, no. If you sell it, you don't get any. If you exercise the call. I know we haven't talked about exercising because I don't want it to be too confusing. But let's say if you took action on what the call is, then you would get no money back for it, because you would effectively be saying, I know there's days left or weeks left on this contract. I want to tear it up and I want to use it. Like tear up your ticket and use it. Well, you get no money because you just teared up the days left on your ticket. Now, in this case, for intrinsic value, you would actually get money out of it. But that said, let's go to our next point, which is why it's so important that you want your things to happen fast. And that's because contracts depreciate each day. And the shorter the time frame, the more they depreciate. Let's go. So at $7, let's look at what's called theta. So how much money are you losing every single day on this contract? So this contract is $215. You're losing, you have to multiply this by 100. So 0.002 times 100. You're losing 20 cents. So this is $0.2. So you're losing 20 cents of this contract value in a day. So after one day, you have 20 cents less. After another day, you have 20 cents less. And the closer and closer it gets, the faster expiration becomes. So you can look at theta expiration. And this is why it's not ideal to buy in a short-term frame, because this is how much your contract expires. You can notice that initially, oh no, this is, let's do time to expiration right here. So you can see that as time goes on, you start to have exponential decay. What that means is initially, let's say you're a year out, you don't lose much of your contract value as the days go on, But once you start reaching that, like, rule of thumb is generally like month to 2 month mark, you start to dramatically increase the amount you're going to lose money, dramatically increase. So you start losing quite a bit. So let's look at it this way. So here you're losing, how much was it? 20 cents. Let's go to sooner, August. Look at $7 strike price. How much are you losing a day? You're losing now 59 cents. So now you're losing 59 cents a day. Let's go to a month from now. How much are you losing? You're losing 68 cents a day. Doesn't sound like a lot, but this contract's only worth $19 and you're losing 68 cents a day. That's a lot. What about this one? 650. I know it's not the $7 contract, but let's talk about the 650. This costs you $17. How much are you losing a day? You're losing times 100, $1.80 a day. So you can see why the shorter time frame, you lose a lot of your money every single day. That's why it's important. The goal of this the contract is you want it to move up dramatically before expiration. The earlier the better, and you sell it back for a profit. You don't want to wait because every day you're losing money by holding that contract every single day. And on the other hand, me, when I'm selling covered calls, every day I'm gaining money because the contract becomes less valuable. But that's it. If you haven't learned about covered calls, I think I have a video on it. And if not, I'll go ahead and create one. But anyways, if you're buying call options, every day you're losing money because of that data. So now, what are some things to consider? Implied volatility, IV. So generally, contracts, they increase in value significantly if there's an increase in implied volatility, which means there's like a lot of excitement. A lot of people are buying call options. A good example right now, implied volatility, where it's high, is like GameStop, AMC, and so forth. These generally have high implied volatility, which means the contracts are very, very expensive. And so this also goes up during earnings. It's generally a bad idea to buy calls before earnings because the call price will be much, much higher if it's the date after earnings. So let's say you want it to expire. So I'll give you an example, actually. Let's say I go to this next week. How much does it cost me to buy this, the $7, $10? Let's say I go one more week, $15. Let's say I go next week, $19. So notice it's only going up a few dollars, and I can tell you exactly where earnings are. Here, $24, right? Not that much more. Up here, $30. So it's went up $6, right? From 24 to 30. August 2nd. Watch this. $44. Okay. Yeah. So from here, $44 to $30. Why did it jump up from $30 to $44? Why did it go up $14 in a single week? Because that's when earnings is. And how do we know this? Watch, we can actually just go to our SoFi. We can go to our SoFi and we can see that its earnings is before August 2nd, right? Its earnings is July 29th. So that's the week that you would have earnings, and see how much more expensive it is. It's way more expensive to do it on after earnings. And so that means it's harder for you to recoup your investment. And that's why it's generally a bad idea to buy it for earnings. Plus, you never know if the stock is going to go down and then you lose all your money anyways. So it's just more expensive. Another one is major events. Another major event that happened, I think last year, was there was like a vote to dilute shareholders. I'm not sure who would vote for, but that was a major event. And during that time, a lot of options were very expensive, very, very expensive, because people didn't know if it was going to go through or not. You know, there's a lot of uncertainty that increased values. Now, what are some safer methods to do this? Once again, I don't recommend, this is not financial advice, I don't recommend buying call options. But generally, if one were to buy call options, you would want to, number one, buy in the money. What that means, as an example with SoFi is at 650. So ideally, I would want to buy $6 calls or $5.50 calls. I want to buy them in the money, right? So what are some examples that I would buy? Now, because this kind of pairs the next part, is I want it to be a long expiration. I want it to be a leap because it's more likely for it to happen. So I would actually prefer myself to go into January 2026, and I would buy, let's say, like a $4 contract. Yeah, $4 contract. So let's do this as an exercise. How much intrinsic value is there in this? So $4 plus 345, that's, let's call it roughly 750. 750. So I break even at 750, roughly. 745, I know, but 750. So I have until January 2026. And if it goes up to 750, then I recoup. Sorry. If it goes up to 750, then I'm starting to. Then I broke even. I broke even already. So it just has to go from 650 to 750, and I broke even by January 2026. Now, any dollar past 750 is just icing on the cake. That's profit now. If it's an extra dollar, an extra $100, an extra $2, an extra $200, and so forth and so forth. And if I think this company is solid, which I do, then that would be a good investment for me because I only have to spend $345 to buy 100 shares effectively instead of $650. Now, once again, we said if I buy the shares outright, which I have, then I have forever, either until the company goes bankrupt or I have it until forever. So I could wait until it goes past, however long it takes. Let's say the stock market corrects this year, goes down a lot. Let's say for the next 2 years, it's low. That's okay. I can keep waiting. But if I'm confident that it's going to happen within the next 2 years, I can make more money on this. I like to be a little bit safer, so I'm not going to do that, but Leap's pretty safe. So how much intrinsic value is there in this contract? Well, from $4 to $650, that's $250. So 250 out of the $345, about over 2/3 of it is actually intrinsic value, which means this contract actually has value, right? So how much am I paying for just the time, the extrinsic value part? Well, the rest of it, which is 345 minus 250, $95, right? I'm paying $95 for that time. But notice, if every single day it's losing a little bit of value, very little. It's only losing 14 cents a day. That's nothing. Right, 14 cents a day. How many 7 days before I lose a dollar? And this is $345. That's the nice thing. The theta is low. You have much more time for your move to happen, and you can sell it back. Right, you can sell it back if you don't believe in the position anymore, and you can get some of your money back if things change with the business. Now, last thing I want to say is this is not financial advice and I don't recommend it. So to be safe, what do I tend to do in my own personal stock journey? I tend to do the opposite of this. I tend to sell covered calls. So the people who would be buying these contracts, who do they get them from? They get them from people who write the calls, which is me, the people who sell the calls, and other people. Now, there are more advanced strategies for using calls. These are what hedge funds use when they typically short a company. When you short a company, you run the risk of having a GameStop happen to you where let's say the price goes up incredibly high and you get you get caught by surprise. And so what happens is you can lose all your money. So if you short a stock, you can lose an infinite amount of money. The higher it goes, the worse for you, because in a short position you're looking for it to go down. And so but I won't go too much into that, but it's effectively a way to protect yourself is in a shorting position. If you were to short, you would buy calls so that once it reaches a certain price, you kind of cap the amount you would lose. So you would still lose money, but it's like buying insurance for yourself. You would buy insurance so that you don't lose all your money. You still have a way to get out. So you can't lose like an infinite amount of money. Now, what happened in GameStop? Well, those people got greedy. They didn't buy any insurance. And if you didn't buy any insurance, then they got wiped out. That's what happened to those hedge funds. So I hope that made sense. Thank you so much for watching. Actually, before we go, I wanted to show a few pictures. So once again, you could look at a definition of a call option. I like these pictures because watch this. The strike price, that dollar price, is not when you gain money, because you first have to recoup your investment, the premium. You have to recoup your investment. And then after that, after the break-even point, then you start to make profit. Whereas if you just bought shares automatically, you're starting to make money, but you're not going to make as fast money as if you're not going to make the same proportion, the same percentage of money as you would have if you bought call options. So that's the kind of nice part about it. So let's say you bought a call option for $300. So it costs you $300, and right now it's $50. Well, if you bought the stock and it went up to $53, you would have made $300. But if you buy a call option, for a strike of 50, which means you start making money at 50, so you bought it at the money. What happens is you have to first recoup your investment, so it has to go up $3 for you to recoup that 300, and then afterwards you have intrinsic value added to it. Now, let's say it made this in a day. Let's say that same day you bought it is the same day it went up $3. It's not that you have to wait for this to happen, you start gaining money because there's an intrinsic value. So effectively what I'm trying to say is if you buy a call option and it goes up right away, then you make profit. Yeah, that's all it is. The sooner it goes up, the better. So these are just some examples. These are talking about it from the perspective of if you wait until expiration date, but you don't want to wait for that. Okay. So hope that makes sense. Thank you so much for watching. I'll go ahead and create another video on put options, which will mirror this exact same set of notes. Thank you so much. And please like, share, and subscribe if you did enjoy this video. I'll be creating some more content very soon. Thank you.